So if you're watching this video, DocuSign has been on the rise. After hours trading, the company's gone up 17%. Now, I want to bring this into the stock research tool, but let me just show you what's going on. So just reading this article here, it were adjusted earnings of 44 cents on revenue of 622 million, and it's up 22% year over year. And subscription revenue for the quarter totals $605 million, an increase of 23% from a year ago. So that has warranted a 18% pretty much increase. We've closed it at $57.95. I'm gonna load this up here in the stock research tool. I'm gonna take a look at this company. So take a look at DocuSign. So here's the thing, folks, about speculation and news and stuff like that gets reported. So this company closed at $57.95. They've made improvements over the revenue over the last little bit, but the company's stock price has jumped up 10%. Now, you may not think that's a lot, and you'd be foolish for thinking that way, because that is a huge jump. And when you bring this into the research app, where it scans the company's financial statements, so the balance sheets, the cash flow statements, and the income statements, we are not getting a healthy score on this business. And this is a fairly new business. It's only been on the markets from 2018, so we don't actually have any 5-year numbers just yet. But taking a look at this, folks, we are grading this company a 2 out of 10 because of their balance sheets, their income statements, and so on and so forth, and what they have not been doing. So take a look at this, folks. With DocuSign, the only things that we've got positive marks on is our free cash flow growth, growing over the last little while since the company's been in business by a considerable amount, which is great, and our revenue. That's phenomenal. However, we have a lot of negative numbers year over year. On average, our return on equity is negative 40% compared to a negative 33% in the trailing 12 months. Our PE ratio is in the negatives. Our net income is also in the negatives. We have negative return on invested capital for our trailing 12 months and our 5-year average. There's not a lot of positive numbers. Our current ratio is sitting below 1.5. We have a huge debt to equity issue sitting at 306%. And I'm not trying to bash on this company, but I'm also just trying to educate those that are buying into these companies and just to understand what the reasoning is. The company showed an increase of revenue over 1 year, and you believe that the whole market cap or the whole price of the stock should go up 10% based off that one little piece of information. For me, that just doesn't make sense. I want to see consistency. I want to see this done over the next 5 years. Do I think that's going to happen for this business? No idea, but this might be the start. This might be the start, and some people are saying, well, why not just get in early? Why not just get in early on this company? There needs to be a solid track record, folks. That's my prerogative, is to find a company that has a proven track record of showing increase of revenue year over year. Now, with DocuSign, I just don't see that just yet. And when I see a red board here, that doesn't get me excited at all. Doesn't get me excited. Let's jump in out of curiosity. Let's go to the income statements and just see what's going on here. And if you want to get your hands on the software, folks, it's coming out super soon. I am like on the tail end of getting this out to you. It's going to be my own personal website. So for my viewers and subscribers, stay tuned because you'll love this software. It has all this information available to you. So take a look at this. With our revenue slowly jumping up. Okay, it's almost doubled from 2021 to 2022. Looking good. And our cash flow, that was the biggest thing where we're seeing an improvement. That's quarterly basis. Let's go on an annual basis for cash flow and see what we have here. So 2017, we were in the negatives. Now we slowly crept up, and now we're almost at $500 million. Pretty good. Our net income, though, however, not so good. Not so well. It's pretty much in the negatives across the board. Along with that, just to go based upon what I was explaining earlier, they are increasing the amount of shares outstanding. They have 7%, which is ludicrous to me. You're taking on all this debt. To build equity or to leverage your capital within this business, sitting at 306%, and yet you are also issuing shares. by creating more equity with the shares. So you have all this, you're diluting your shareholders. That's just bad business practices. That's just bad business practices in my book. So I look at a company like DocuSign, and not to I mean, look, if you're making money and you're trading this business, that's one thing. But if you're trying to invest into this, and I should have probably started the video off with this, if you are trying to invest into a company and for the long term, what it comes down to is what is shaking up these fundamentals. So here's the thing, folks. When I see prices increase without any kind of justifications, I get very skeptical. I get very skeptical, as you should as well, because what has changed? What has changed? Just one little year of increased revenue? I'm not saying I don't want this company to do well, but I also want to be able to purchase this company at a fair price. With that being said, folks, let's jump in to the price analysis section of my channel, or my video here. Oh my God, my software has a price analysis section. What we'll do here, folks, we'll do a 10-year analysis, and I'm going to do 3 different assumptions to price out what we should be paying for DocuSign today. Now, the only thing here, folks, that bothers me is that we have a lot of negative numbers to play with, and I don't want to do that because that means I am speculating, where I would rather see some positive numbers. So I'm going to fill out these boxes, and we'll touch base in just a quick second, so stand by. So folks, before we just jump into the last part of the video, if you're enjoying it so far, hit that like button, hit the subscribe button, and as I said, this software that I have in front of me that screens all these companies will be available to you, my viewers and subscribers. I'm on the last tail end of getting it out to you. It's a lot of work for one person to do. Let me tell you, I didn't think it would be that popular, but yeah, apparently you guys want it, and I'm tired of making you guys wait because it's going to be awesome, and there's a lot of features coming out. So take a look at this, folks. I put this into the price analysis section. I've done a lot of conservative numbers if you're new to the channel. So what I like to do is I'd like to give a little bit of a haircut based off the revenue growth numbers, because I am doing a 10-year evaluation to try to give myself some decent margin of safety, as well as I stay true to our profit margins that we have, so doing -3 on the low end, 0 in moderate, and aggressive being 3%. Now you may say, why only 3%? Well, they haven't shown a profit thus far, so this is my speculation period, being in the moderate and aggressive categories. Free cash flow, I stayed somewhat consistent, as well as I put a price to free cash flow and PE ratio being at 14, 16, and 18, and the PE ratio being 12, 14, and 16, something very moderate below our 22.5 that we're looking for. Desired return of 13%, it comes out to be 58.61 on average price calculation, and the current price is 57.95 at the time of closing. However, it is much more above that as it's gone up over the after trading hours. Okay, basically the price has gone up by a considerable amount after hours. Now, here's the thing, folks. This price is being very generous because I feel like it's around our conservative average. Even with that being said, with a -3 profit, it's still in the 61 range, which might be a buy depending on how you view it. But on 18 on the low end, it comes out to bring this price down to about $35 a piece. Now with the 0% profit margin and 21% revenue growth over the next 10 years, you're looking at around $57. There's no calculation here because of the 0% profit margin. That's why it gets skewed. But if you want to take it for what it is, it's in this $80 range, as well as our aggressive average coming in at that $80 range. So where do I think it lies? Potentially somewhere in here between a conservative and moderate. That would make the most sense to me, and I'm leaning more so towards our conservative numbers just because they haven't shown a profit just yet. So here's the thing, folks. What can you take away from this information? Well, the price is shot up by an incredible amount over a lot of hype, and hype is something we should try to avoid, because what comes with hype on the other end will be fear, and then you'll eventually see this price start to come down. And it's been evident with this company. Take a look at this. If this chart isn't evident enough, came out and then boom, started rallying incredibly hard to the point where it got up to what, $201 in the first little bit, and then it came down just a little bit. It closed at 190, in May 2021, just last year, guys, just last year, and then climbed again up to $298. Someone bought at that amount, $300 for this company that doesn't make that much money, and now they've recently just reported an increase in revenue. And take a look at that. From $300, it is eventually just shot down pretty much in half to down to 150-ish, and now here we are sitting at $57.95. Obviously that price will change by tomorrow once the trading is done, but look at that, guys. You see how crazy a stock price can change? And now I would argue that the company is in a better state now at $57 than it was when it was at $300. So this is the mindset that we have to try to go forward with, and that is trying to be as rational as possible. Like, take a look at this 52-week spread. 53 on the low end, 288 on the high side. So if you are planning to invest into this business, take what I've put here, obviously as a grain of salt, but with some consideration, right? If you assume a negative profit margin over the next 10 years, you might be buying this company potentially at fair value right now. What I would do personally, because eventually the stock price will eventually follow the value of the company, and this may potentially fall again. I think the software is great. I've used this for a lot of my own personal work, but the 2 points that I'm trying to make in this video is that right now I believe the company is extremely overvalued, and it's had such a negative, and this reaction that people have had is in the wrong intention. This is why people feel that greed, and they have that FOMO. They don't want to miss out. So if you're trading this company, best of luck to you. If you're planning to invest in this company, potentially wait. That is my personal opinion. But there's a lot of red across the board that I want to see green before I can personally consider this company. So that's it. That's the video, folks. If you want to see this another company analyzed, write it down in the comment section down below. I read all the comments, try to get back to you guys as much as I can. And yeah, let's get a conversation going. What do you think about this analysis here? And if you have a friend that's potentially looking to buy into DocuSign, well, send them this video, because maybe it'll change their mind. And with that, folks, I'll see you in the next video. Thank you so much for watching.